to our today's event. Thank you very much for your coming. I see a round of very exquisite people. Thank you for your readiness to listen to somebody who is speaking outside the usual geopolitical sphere. Of course, when I see Colonel Wacher and others, but I guess wars in this period are not fought just by military people, are not fought with tanks and fighter aircraft or with chariots, but also in the financial sector. And we do have the privilege to have somebody in our middle today who will be ready to talk about it, and who certainly belongs to the best experts you can find on the transatlantic stage to talk about finances and the fiscal and monetary situation on the world, and also the consequences not only for this future development in America, but also in Europe. We have the honor to have James Rickards with us. James Rickards, who has studied economy and international relations at New York University, University of Pennsylvania, and Johns Hopkins. He is an expert, being 35 years on Wall Street and in different financial institutions. And he is a man who wrote bestsellers. Bestsellers of New York Times with the title The Death of Money, and also Currency Wars and others. It's a great privilege to have him here, and now I just will leave the stage. Velina Tchakarova, the head of our institute, will make the moderation, and we all are looking forward to Mr. Rickards' presentation and also to the discussion that shall follow afterwards. Thank you very much.
Thank you for that kind introduction, Dr. Posselman, and also would like to extend thanks to the Diplomatic Academy for providing the venue this afternoon, and our friends Dr. Posselman and Velina Tchakarova from AIES for organizing and hosting the event, and thank you all for showing up this afternoon. We have a great audience. Looking forward to going through this presentation. I usually prepare slides in inverse proportion to the expertise of the audience, meaning a general audience I might have 30 or 40 slides, but the more elite the audience, you might not have any. This is an extremely elite audience because of the academic background. We happen to be in Vienna, the home of the Austrian school, and when I debate economics, my toughest opponents are always the Austrians. You can get the Neo-Keynesians and the monetarists on the run pretty easily, but the Austrians will fight pretty hard. So we have that going for us, but what I'm going to present in the next few minutes is actually a thesis, and I thought, well, maybe a few slides wouldn't be a bad idea, even with such a great audience, to illustrate the points. And indeed, I'm going to finish quickly, and then we're going to have more of a seminar-style format. We're certainly welcome questions from the floor, and Velina will have some questions, maybe some challenges for me as well, and we'll look forward to all of that. But this is the first time I've done this particular presentation. I've done hundreds all over the world, but it just occurred to me, or it sort of came to me gradually, that after spending a few decades researching the dynamics of economic systems, what works and what doesn't, monetary policy, fiscal policy, Neo-Keynesians, monetarists, etc., and getting a lot of insight and making a lot of progress. It's only very recently that I've been able to put all of this together into something that I would regard as at least a special theory. There might not be any general theories in economics. You know, Keynes' most famous work was his general theory of employment, interest, and money. But he called it a general theory, I think out of a little bit of Einstein envy, because Einstein had just, not too long before released the general theory of relativity, so Keynes had his general theory. But I think in fairness, it's more of a special theory, which just means, it doesn't mean it doesn't work. It means that it works under limited conditions, and it's critical to understand what those conditions are. So I won't go so far as to say I had a general theory, but I've sort of come to a special theory of monetary fiscal policy as applied to the world economy. And this is the presentation of that. So I think it's wonderful to have such a strong and renowned academic setting to be able to do this. So assuming I've got this correct, the first slide, I'll go through this quickly. This is really the baseline, this is the baseline analysis. And what we're showing over here are, over here, these, the blue areas are economic expansions, the red areas are recessions in the United States. And I want to make a very simple point, I won't spend a lot of time with this, but economic expansions are getting longer, which is a good thing, but they're getting weaker, which is a bad thing. And the trend is very obvious here, you have 4.9%. Now this expansion here, the 4.3%, that's Ronald Reagan in the 1980s. This 3.6%, that's the Clinton expansion in the 1990s. They were both very long, very strong expansions, but you will notice that this one is a little bit longer and a little bit weaker. This is the Bush expansion of the early 2000s. Not all that long, was truncated by the global financial crisis, but you see the annualized growth was 2.9%. And here we have, I'll call it the Obama expansion, although it does extend 2 years into the Trump administration. This is the longest expansion in U.S. history. We're now in the 11th year of an expansion. We've never had anything quite like it. But it's also the weakest expansion in U.S. history. The growth is 2.3%. And if you take the average of these three expansions, well, actually all four, so draw a line in 1980, average growth in post-1980 expansions is about 3.3%. Average growth in the current 10, now going into 11-year expansion is 2.2%. The difference between 3.2 and 2.2 may not seem like a lot. It's actually huge. Because you take 1%, apply it to a $20 trillion economy, and compound it over 10 years, the lost wealth, the difference between those two expansions is now approximately $5 trillion. In other words, if you took this square and just said, well, let's just bring it up to 3.3% for the same period, that missing part of the block is $5 trillion. Imagine someone walking into the President of the United States, handing the President a check for $5 trillion and say, here, Mr. President, spend it any way you like. In defense, social programs, pay down the debt, whatever suits you. That's how much wealth America has left on the table. That's how much missing wealth there is due to our ability, the U.S.'s ability to grow at the average of just the post-1980 expansions. That's not even counting early expansions, which were even stronger than what we're showing here. By the way, this is a global phenomenon. Of course, the 90s were known as the lost decade in Japan. They're now approaching their fourth lost decade, the three behind them. The U.S. has just had a lost decade, which is this 2.3% growth. We're now entering our second lost decade. So this is an enormous problem. The question is why, and what can we do about it? And that's what I want to spend the rest of the time on. The why part is straightforward. It's partly demographic. The populations around the world are flat or declining. Russia's population is declining. Japan's population is declining. Japan's population is declining. China's population is flatlining and aging. The U.S. population was increasing slightly, but that was mostly because of immigration. When President Trump cutting off immigration, the U.S. population will soon trend down to flatline. Of course, in Europe, it's about the same, not quite replacement level, which is enough new children being born to replace the population size. So So around the world, with few exceptions, we see these declining or flatlining populations. There are a lot of definitions of growth, a lot of definitions of GDP, some more complicated than others, but the simplest way to understand economic growth has two components: population and productivity. How many people are working? How productive are they? Productivity is declining for reasons that economists don't entirely understand. Populations are flatlining or declining for very obvious demographic reasons. Well, if your two components are flat to down, that's what's happening to your growth. It's flat to down. We're missing one of the key ingredients in economic growth. The other problems I'm going to suggest are deflation. We live in a deflationary world. That doesn't mean we can't have inflation, but absent central bank manipulation, central bank policy, the world left to its own devices would want to deflate because of low-cost manufacturing in China, most obvious, but there are other reasons as well, technology and low-cost manufacturing. So if you have declining population, a deflationary bias, and excessive debt, which we do, that's why we can't get growth back to where it was. That's the recipe for that. So let's take a little deeper dive again, do this quickly. So on top, we have this is U.S. money supply. This is base money from 2008 to 2019. Here you can see QE1, that's that spike, quantitative easing or money printing for one of another term. There's QE1 that ended, the economy actually grew a little bit weaker. Here we have QE2, the other spike up, and then again the economy, the money supply flattened out, and the economy grew weaker. We had a recession in 2013. And then finally QE3, which was larger and more long-lasting, and then that came to an end in 2014. Since 2014, the money supply was reduced very, very gradually until 2017, when it began to tail off a lot more quickly. And also these green lines, this is the period of rate increases. So our first interest rate hike was December 2015, but then we didn't have one for a full year until December 2016, and the tempo really picked up in 2017, 2018. And as I mentioned, in 2017, we began what we call QT, quantitative tightening, where the Fed actually reduced the money supply. There are famous pictures of helicopter money. They show manic-looking Bernanke hanging out of a helicopter throwing money to people below. Well, imagine Jay Powell standing by a furnace with a pile of money, shoveling the money into the furnace, burning the money. That's what the Fed has been doing since 2017. So in this period here, from 2015 to 2017, you had a double tightening. You had interest rate increases and reduced money supply, a very severe form of tightening. Why? The U.S. economy was weak. It was, normally the Fed follows the business cycle. It's been doing that for 100 years. So the economy gets hot, unemployment gets low, inflation picks up, the Fed finally wakes up, they go, oh, we have to tighten policy, we have to raise interest rates. They chase the economic growth until finally they tighten too much and the economy goes down, they watch it go down, and then they ease policy and the whole cycle repeats itself. That's what the Fed normally does. That is not what's happening this time. For the first time, the Fed has been tightening into weakness. The growth is what I showed you in the prior slide. Why on earth would the Federal Reserve tighten with slow growth and weakness? The answer is that they have to undo the extreme policies of the period from 2008 to 2015, where the Fed quadrupled the money supply and cut rates to zero and left them there for 6 years. They had to normalize the balance sheet, normalize interest rates. They had to get the balance sheet down to maybe $2.5 trillion from $4.5 trillion and get interest rates up to perhaps 4% or even higher. Why? Because to get out of a recession, you have to cut interest rates 4 to 5%, at least in the United States. That's what the history shows. How do you cut interest rates 4% when you're at 2%? You can't. And if you get stuck in that situation and you get back to zero, then what do? Go back to QE. How do you print money when your balance sheet's already $4 trillion? You take it to $5 trillion, $6 trillion. In other words, the Fed was trying to raise rates and reduce the balance sheet in a weak economy so they could normalize and prepare for the next recession. The conundrum is, how do you prepare for the next recession without causing the recession that you're preparing to cure? And I said years ago that they would not be able to do it, that I understood the problem, They look ahead and say they will not be able to do it. It will cause a recession. And we came extremely close last December, December 2018. Between October and December, our stock market fell 20%. Jay Powell finally got the wake-up call. He stopped interest rate increases. By the spring, he announced interest rate cuts. And then just recently, at the end of July, they said they were discontinuing their policy of reducing the balance sheet. And just yesterday, they announced that we're going to print $1 trillion of new money between now and October 10th. Now, they're not calling it QE, but I don't care what they call it. They print $1 trillion of money. So if I came back a month from now and showed you, there we go. If I came back a month from now and showed you this line, this is the money supply, it would go like that. It would shoot up about $1 trillion. So interest rate hikes are done. Interest rate cuts are on the way. The balance sheet's expanding. The Fed has failed. They have failed to normalize before the next recession. They're going back to the playbook they had in the last recession. That means they have no dry powder, if you will, no capacity to fight a recession. Now here's the point. This, you are familiar with the quantitative theory of money. Money supply times velocity equals nominal GDP, which has two parts, real GDP, which is the Y, and the price adjustment, which can be inflation or deflation. So this goes back 100 years, and it's very well known. And Austria, I don't want to pick on Austrian economists, this goes on in Austria, but European Union monetarists and Austrian would all say the same thing, which is if you print money, you're going to get inflation. Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon. That's an exact quote, not a paraphrase. Well, if you're increasing the money supply from 800 billion to 4.5 trillion, where's the inflation? We never got any inflation. Nothing significant. Well, why is that? What's wrong with Milton Friedman? What's wrong with the Austrian school? The Austrians, in fairness, they would point to asset values, and I don't consider that inflation, but yeah, asset values have been going up, so that's true. The answer is velocity is collapse. And that's the lower slide. This is a longer chart. This goes from 1997 to 2019, but you can see that velocity is collapsed. So you take the m times v part. Milton Friedman assumed that velocity was constant. Well, if velocity is constant, and if there's a capital real growth of about 3.5%, then monetary policy is easy. You just dial it up or dial it down, like a thermostat on a house, and as long as you don't go too far, you won't get the inflation. You can actually get a maximum real growth without inflation just by tweaking the money supply, if you know what you're doing, if velocity is constant. The problem is that velocity is not constant. As I say, it has collapsed. And I remind people, $4 trillion times zero is zero. In other words, if you don't have velocity, you don't have an economy. And all this money printing was barely enough to offset the crash of velocity. And the point being, this is what caught all the mainstream economists, all the schools of economics by surprise, which is that velocity would actually collapse in the way I've shown. So this I call the failure of monetary policy. You cannot print your way out of a slump. You cannot print your way out of a recession, let alone stimulate growth, if you have declining velocity, which we do for a variety of reasons, mostly psychological, and that's really the point. If you have a psychological element, if you have a reaction function, everyday people responding to central bank policy in ways that economists and central bankers themselves don't expect, you'll get these kinds of results. And this is why we cannot print our way, we cannot print our way out of slow growth, we cannot stimulate the economy, we cannot achieve trend growth as long as velocity is declining. And that is not something that monetarists or any other economists can control. That is a psychological phenomenon. You have to manipulate the psychology. You have to change the psychology of citizens everywhere, starting with the United States. Now this slide is a little dense, but I'll just take a minute. So this, when I say dense, I think I put too much information in, but where's my, sorry, I'm not saying a little difficult with the laser. Anyway, so this covers the period from 1980 to 2019. The blue line, and that's the key thing I'm showing here, that blue line is the debt to GDP ratio of the United States. But it's not different around the world. We find the same thing in Europe, China, Japan, Bank of England, etc. These, I'm just showing you sort of different presidential administrations. So we started at 30%, that's not zero, that's 30%, which is a very comfortable, very sustainable level. There's no country in the world that would be happy with 30% debt-to-GDP ratio. Ronald Reagan and George H.W. Bush took it up to about 50%. So that's 60%. They did this as part of a defense build-up primarily. They won the Cold War, so we got something for the money. But they got to this level, so the 60% level. Anything below 60% is sustainable. 60% you all know is what the Maastricht Treaty calls for. This is what Angela Merkel is trying to impose on all the members of the European Union, the European Monetary Zone. 60% is a little high, but it's sustainable. Once you get past 60%, up to 90%, it's not sustainable. You can go there, you can run your economy, but you're getting closer and closer to the point where, unless you turn it around, you will be heading for trouble, which I'll explain in more detail. Well, what you see here is Bill Clinton, and yeah, it got a little bit higher. Clinton did a very good job of getting it back down below that 60% level. This was called the peace dividend. We weren't fighting any wars, at least not any big ones, with a good tax base, a growing economy, and without the military expenditures. Clinton got that back down, actually ran surpluses the last 2 years of his administration. The first surpluses the U.S. had since 1969. Then Bush comes in, and Bush spent money on the war in Afghanistan, the war in Iraq. It went up, okay? It went up to about 64%. But we still had pretty decent growth during that period of time. Where the curve bent, where it went hyperbolic or whatever you want to call it, is the Obama administration. And you can see that right there. It goes up past 90%, and today it's about 106%. And Trump is not helping. Trump has brought back trillion-dollar deficits last seen in the early years of the Obama administration, 2010, 2011. I like to say we used to have bipartisan competence. Today we have bipartisan incompetence. So this is not a Republican or a Democratic issue. It's not a political issue. It's an economic issue. It has to do with kind of the will to engage in tough decisions when it comes to economic policy making. But the point is, what's the significance of 90%? I've got that line right there. And there's where we crossed it, right there around 2011. And, you know, fairness, Obama had to do something to stimulate the economy. It didn't work, but they did it anyway. $832 billion of additional spending over and above the baseline deficit at a time when the U.S. economy was contracting. That's what drove that. But it continued in the later Obama years, and it's continuing into the Trump administration today. What's the significance of 90%? There's a large body of research led by Carmen Reinhardt and Ken Rogoff, both now Harvard professors. Carmen used to be at the University of Maryland. In their book, in their joint papers, but also separate papers that they've done with collaborators. It's all readily available, not difficult to find. And they show, looking at 100 years of data, looking at over 100 economies, developing markets, emerging markets, developed markets, many different slices of the data. Once you get past 9%, you are heading for default. And another thing that happens is that the Keynesian multiplier, this is why I referred to Keynes earlier as being a special case rather than a general case, a general theory. Well, Keynes faced a liquidity trap in the late 1920s, a shortfall, what we now call aggregate demand. And he had an insight. He was very pragmatic. He said, well, if people won't spend, government has to spend. If people are hoarding dollars or sterling or currency at the time, hoarding gold, if they're not willing to spend, how are we going to get the economy moving? So what we need is we need the government to spend, run deficits, stimulate the animal spirits, get the lending and spending machine going, and pull the economy out of its funk or out of its recession, or in that case, a depression. Well, Keynes was right, subject to certain conditions. The conditions had to be, you're coming out of a recession, or you're either in it or just out of it. Your debt level is fairly low. You have headroom and borrowing capacity. You have high unemployment and unused industrial capacity. In all those situations where there's slack in labor, slack in industrial capacity, and borrowing power, yes, at least on a temporary basis, you can bring demand forward through government spending, and that worked. The problem is none of those conditions are true today around the world in general, but certainly in the United States. We're in the 11th year of an expansion. We're not in a recession. Unemployment is at a 50-year low. There's no slack in the labor market, at least not much. You know, industrial capacity utilization is high. So we don't have, and our debt to GDP ratio is 106%. We don't have all those preconditions. What we have is a situation that's heading for default. Now, Reinhard Rogoff defined default broadly. So it can include non-payment, I just don't pay you. But it can also include capital controls. So I got the money, but I'm not giving it to you. Currency controls, currency devaluation. Here's your money, but it's not worth very much. And inflation, which is just another way of saying, here's your money in nominal terms, but it's not worth very much. We'll say that to the Chinese, you know. Here's $1 trillion we owe you, good luck buying a loaf of bread. Those are all different forms of default. They all amount to the same thing. You are not being paid as agreed in real terms. There's no reason for the United States to not pay any money because we can print the money. If you're Argentinian, you owe dollars and you print pesos, you have a problem. But if you're the United States and you owe dollars and you print dollars, you don't have a problem, you just print the money. But we get very quickly into inflation and worse outcomes. So this is the failure of fiscal policy, which means, and in particular, the famous Keynesian multiplier says government borrows $1, spends $1, and you get $1.50 of growth. Or borrow $1, spend $1, and you get $1.25 of growth, whatever it may be, the multiplier varies. What Reinhard Rogoff showed is that once you're beyond 90%, people's behavior changes. They expect the government to default. They actually save more and spend less. They defer spending. So what happens is you borrow $1, spend $1, and you get 90 cents of growth. You get less than the $1 that you borrowed and spent. And when you're in that situation, you cannot borrow and spend your way out of slow economic growth. You can't. The only way out of it, you can grow, but we showed in the last slide that we're not growing because of demographics, debt, and deflation. You, at lower levels, you can borrow your way out of it, but past 90%, that doesn't work. So the point of these two slides is just to say that monetary policy has hit a dead end because of declining velocity and a psychology that says we'll save more. Fiscal policy has hit a dead end because we're beyond the 90% threshold, and people actually lose confidence in the ability of government going forward. They start bracing for default rather than borrowing and spending more. So just to summarize, my point is real growth is structurally limited by demographics, debt, and declining productivity. Monetary policy cannot stimulate real or nominal growth because of declining velocity. Inflation is always and everywhere. It's a psychological phenomenon. That's my take on Friedman's dictum. Fiscal policy cannot stimulate real growth because of the 90% threshold and expectations of default, where people actually save more. The U.S. shouldn't resort to non-payment because we can print the money. Currencies don't work because of retaliation. The only solution is to change inflationary expectations and increase velocity. In other words, not money printing. How can you get people out of a deflationary mindset into an inflationary mindset? A psychological problem. How do you actually do that? And what is the best way to change inflationary expectations? Fortunately, there is an answer. And it was implemented by two United States presidents, Franklin Roosevelt and Richard Nixon. And they both did it the same way. They devalued the dollar against gold. Now the problem in the currency war, I always say that forecasting currency exchange rates is child's play because it's always a cross rate. They never go to zero. I mean, not kind of Zimbabwe, but if you're talking about the euro, the dollar, sterling, and the major currency, they never go to zero. They just go up and down against each other. When people say we have a strong dollar, what they mean is that the euro is at $1.10. Notice that a weaker euro. When people say we have a weak dollar, what they mean is that the euro is up to $1.30. It's stronger. But it's always a cross rate. There is no yardstick. There is no one thing. And when people say we have to devalue the dollar, I turn to them and say, so you expect a stronger euro? Oh no, the euro's got all kinds of problems. I say, well, it's one or the other. They cannot both go down against each other at the same time. That is a mathematical impossibility. There is one and only one form of money where every currency in the world can devalue at the same time. And that is gold, because there is no central bank of gold, no one prints gold. You can't, kind of sum it up out of thin air. And in 1933, in the depths of the Great Depression, the longest sustained period of deflation in U.S. history, President Roosevelt, who was not an economist, didn't trust our allies, didn't like international monetary conferences, but he was willing to try anything if he could make a good case. He had kind of a fringe commodity expert as one of his top economic advisors, and the expert said, devalue the dollar against gold. That's the only thing you can do. Roosevelt did. First, he confiscated all the gold first, so the treasury would get the profits. But he bought the gold in at $20 an ounce and then raised the price to $35 an ounce. A 75% increase in the price of gold, or thought about differently, a 67 or 69% devaluation of the dollar. When the price of gold goes up, I say to myself, the price of gold didn't go up, the dollar went down. That's the way to think about it. The gold, I think you go by weight, that's your yardstick. And then went back to the gold standard of $35 an ounce. Nixon did something very similar. He raised the dollar price of gold 21% between 1971 and 1973. But Nixon thought it was a timeout. What Nixon thought he was doing, and I've spoken to, there were a handful of people at Camp David that weekend, August 15th, 1971. I've spoken to two of them personally, Ken Dam and Paul Walker, and they both told me that they thought it was a timeout. They thought we would go back to the gold standard at a devalue, a higher price of gold. In other words, we would devalue the dollar, and we would go back to the gold standard with new valuation. Exactly what FDR did in 1933, except it never happened. In the meantime, while we were waiting for this conference, Germany went to floating exchange rates, Japan went to floating exchange rates, the whole system moved to floating exchange rates. We never got back to a Bretton Woods style system. So that the difference between Roosevelt and Nixon, Roosevelt devalued the dollar against gold, but went back to the gold standard. Nixon devalued the dollar against gold, but was never able to get back to the gold standard, probably because of Watergate, his resignation, and other things. If you expand the period to 1980, the price of gold went up 2,185% between 1971 and 1980. Think about what that means. Think of the inverse. How much did the dollar devalue? The dollar devalued 95% measured by gold. So, and we both got inflation. In the late 1970s, we had borderline hyperinflation. The dollar, between 1977 and 1981, the dollar lost half its purchasing power. More than 50% of its purchasing power in 5 years, not 100 years, as people like to cite the statistic, 5 years. And Roosevelt, 1933, in the middle of the Great Depression, was one of the strongest years of the stock market in U.S. history. What Roosevelt did worked. He raised the price of gold, devalued the dollar. And the point is, when you raise the price of gold, it doesn't, nothing happens in isolation. The inflationary signal is oil goes up, copper goes up, wheat goes up. You get the inflation you're looking for. So going back to the last slide, if the only way out for the United States is inflation, which I submit it is, because monetary and fiscal policy are not working, how do you get the inflation? And you can't do it through currency wars because it just goes back and forth. The only way to do it is by devaluing the dollar against gold. But now we have the disadvantage of not being on a gold standard. Nixon and FDR were on a gold standard when they made their first move, but Nixon never got back to one. Today we're not on a gold standard, so how could we raise the price of gold and devalue the dollar? We have to start buying it. The Treasury would have to announce that the U.S. now has a program to double its gold reserves from 8,000 tons to 16,000 tons. Well, I think we all know what that would do to the price of gold. By the way, I'm not forecasting that. I don't think there's a central bank in the world who wants to do what I just said. What I'm submitting for consideration is that you're going to have to do that. That is the only way out of the low growth, high debt, borderline default situation we find ourselves in today. And just to spend a little bit of time on the rest of the world, I'm not being glib when I say this because so much of central banking around the world, so much of economic growth around the world is driven by the United States and the Federal Reserve. And I make the first point, I'm very bullish on the Eurozone. I believe the Euro will remain. It will add members over time. I'm not talking about the exchange rate. That'll fluctuate, and I expect the Euro will actually be weak against the dollar until such time as the U.S. has a recession, in which case we'll devalue the dollar against the euro to get our way out and hopefully help the rest of the world. But the way to understand the Eurozone, I feel a little humbly speaking to a European audience, but what I tell my American friends is that the euro and the European Monetary Union, the Eurozone, is not now and never was an economic project. It was always a political project. And once you frame it as a political project, all you have to do is look for the political will. And if the political will is there, the the euro will remain. When I first said that, there were 16 members of the Eurozone. Today there are 19 members and a waiting list. So I think that bears out what I was saying about the continued strength of the Eurozone. Although the euro itself will remain weak. I'm not looking for stronger growth in Europe. Europe has exactly the same problem as the United States. Too much debt, declining velocity. You can't print your way out of it. You can't borrow your way out of it. You're stuck. And just to do a quick footnote on negative interest rates, the theory is, if I cut interest rates, you'll borrow more, you'll spend more, etc. And if I get to zero, I'll just make them negative, we'll have more of the same. The evidence is that no, that doesn't work. There's an asymmetry. You're through the looking glass. When you actually get into negative rates, why do people save at all? Why do they save in the first place? They have a lifetime goal. They're saving for their retirement, their health care, their parents' health care, their children's tuition, buy a house. There's some reason for saving. If I take your money in the form of negative interest rates, the central bankers say, well, you're going to go out and spend it because you don't want to sit there and watch it go to zero. No. What people do is they save more. They save more. They defer spending. They increase savings. They do the opposite of what the PhD economists expect because they're people. This is a rational reaction function. So negative interest rates produce the opposite result that central bankers suppose, which is one reason why the European Central Bank is on the wrong path with its negative rates, and I expect that to get worse. I already mentioned fiscal policy. Look for Japan and the UK to be winners from all this. Why? The United States is in a major trade war with China. That's well known. We're about to escalate a trade war with Europe. My friends in the United States, they drive BMWs, and they say, oh, you have this fancy German car. I said, no, it's made in South Carolina, but BMWs are made in the United States. But most of the Volkswagen products and AIES and Porsches and others are still made in Germany. They're all going to be hit with very high tariffs in November. So the trade war with Europe is going to escalate. We're fighting that with the wars with that many people. It's good to have a couple of friends. And I think Japan and the UK will be countries that can strike bilateral trade deals, not multilateral, but bilateral trade deals with the US that will help their economies. China will be on the losing end of all this. That's a big debate. I would add, I would watch for signs of political instability in China, social unrest, things that will greatly weaken President Xi's position. And then just a quick footnote, adding on to the gold point, Russia, China, Iran, and Turkey are forming what I call the new axis of gold. They're working on crypto technologies, encrypted distributed ledger, fencing in for blockchain. Permission, which means you can only use it if they say so. It's not Bitcoin, anybody can use it, but permission blockchain, only if you're invited into the club. And they will use this cryptocurrency called the Xi coin, the Putin coin, to keep score on bounced payments among them as Iran sells oil to China and China sells infrastructure to Russia, Russia sells weapons to China, etc. And then periodically settle up with gold. The key being, you need a lot less gold if you're selling on a net basis than on a gross basis. If you have to pay for every transaction, gold, probably not enough gold. But if you're netting out, then there probably is enough gold. Of course, China and Russia each tripled their gold reserves in the last 10 years. I always ask people, are they stupid or do they see something most people don't? Well, I know a lot of Russians and Chinese, they're not stupid. They see a more gold-based system coming down the road. If you're an author, you have to be shameless about plugging the books, so I realize I've been going through this quickly, but these are my books on the subject of my newest book, Aftermath, just came out July. By the way, all these books are available in German from my German publisher, but say a new book, German translation may not be ready for another 6 months or so, but it's on the way, and I thank you very much. Over to Velina.
Yes. Okay. Thank you for this very dynamic presentation that you made with these really interesting slides that we have. By the way, just in case that someone wants to have the slides, you can email us and we will provide it if that's okay for you.
Sure, of course.
And now I'm taking over for the more interesting part of this afternoon's session, which is the Q&A. If there are immediate questions emerging arising from the presentation, please feel free to ask, and let's start with it, and then we will move with some additional questions that we will address with Jim. And by the way, I'm very happy to welcome you here to the capital of the Austrian Economic School. I had to say it. Okay, please. Having the microphone.
Well, thank you very much for this interesting but rather gloomy description. But I would have two questions. One on your slides. Has this GDP brackets of 69%, have they been normalized to account for the untypically low real interest rate? That's question number one. And question number two is, even if America succeeds in inflating by devaluing the dollar, that doesn't bring us out of the liquidity trap and debt rises.
Two things. On the first point, and a lot of my friends from decades in the bond market see interest rates where they are, and because when I started the business, interest rates were, the 30-year Treasury bond was 15% yield to maturity in the early 1980s. My first mortgage was bought an apartment, and my mortgage was 13%. My mother cried because I think her first mortgage was 3%. But I said, Mom, I have a 13% mortgage, but we have 15% inflation and 50% taxes. So my after-tax cost is -7. The bank's paying me to be a borrower. But that was the math. Today you have the opposite situation. Are nominal interest rates low? Yes, they're extremely low. But real interest rates are not that low. And a lot of people who said they can't get any lower, it's a bond bubble, interest rates have to go up, and they shorted the bonds, have been carried out feet first because they didn't quite grasp this distinction between real and nominal rates. And I had a meeting very recently, end of July, in Bretton Woods, with some top central bankers, one of the governors of the European Central Bank, and two senior Fed officials, and I can't mention their names because it was off the record, but just to kind of summarize what they were saying, they grasped this very well, and they said, interest rates are going to come down. I expect them to go to approach zero. Because what they're doing, we have strong disinflation in the United States. So if you want negative real rates, you have to get the nominal rate below the rate of inflation. That's obvious. But if the rate of inflation is dropping, which it is, you have to cut rates radically to get the nominal rate below the rate of inflation to get to negative real rates, which in theory is stimulative. That's what they're trying to do. That was just a shorthand way of saying look for rates to come down at least 1 full percentage point by early next year, maybe approach zero by the end of 2020. The problem, and this goes to the second part of your question, what good does it do you to get to negative real rates and almost down to zero if velocity is declining? In other words, you just have a replay of what we went through from 2008 to 2014. Yeah, you get the rates rock bottom, but velocity is declining and your nominal GDP is flattish. Well, that's where the psychology comes in. That's where the devaluation against gold comes in, because just devaluing the dollar against gold or increasing the dollar price of gold, which is the same thing, that sends a very powerful signal that we haven't seen since the 1970s. And the idea there is that a shock to consumer psychology? Does that get you out of the liquidity trap? Do you suddenly wake up and say, look, I don't have a PhD, I don't know what's going on, get me out of the dollar. I want to buy a car, buy a house, buy gold, buy silver, buy land, buy something, but get me out of the dollar because the dollar is collapsing, which is what happened in the late 1970s. If you get that reaction function, you will get inflation.
Thank you.
By the way, liquidity was mentioned, liquidity problem was mentioned. Are we facing a current liquidity crisis? Is this one of the reasons, if not the main reason, for a very strong US dollar, and what would be the implications for the current global financial and monetary system?
The answer is yes, yes, and yes, but let me explain. I was recently asked, when do you foresee the next financial crisis or liquidity crisis? And I thought about it for a second, and I said, we might be in one. We might be in one today. Somebody very big is broke, and I don't know who it is. It could be a major bank, it could be a hedge fund, some leveraged borrower is broke. We don't know who it is. And what's happening is that the Fed, I pointed out their mistake in reducing the money supply prematurely, reducing it at a time when the U.S. economy wasn't really strong enough for that, particularly in the world of declining velocity. What has happened now is that the so-called primary dealers, these are the 14 or 15 largest banks in the United States, and many of them are European banks and do business directly with the Fed. They are hoarding cash. They have excess reserve positions with the Fed, but those reserve positions have been coming down, not because the banks don't want the money, but because the Fed has been reducing the money supply, and that is the impact. The reserve position goes down. They won't lend it. And somebody's broke and is screaming for money. So this is why the Fed is today, as we speak, and continuing through early October, but let's see if they extend it, adding $1 trillion to the money supply, over $75 billion a day. Why are they doing that? Because they want the banks to build up these excess reserve positions. So in theory, the bank can then lend to or bail out this party who is yet to be identified. I'm not being coy about that. I don't know who it is, but I know the symptoms of distress, even without knowing the name. The problem is, at least so far, the Fed has already done this to the tune of several hundred billion, and the banks kept the money. Why are the banks not on? What the Fed wants, the Fed's saying, like, here's the money, and we want you to lend it to everybody. There is a dollar shortage around the world, by the way, a very acute dollar shortage, which is why the dollar is so strong. But the banks are saying, no, if there's going to be a blow-up, and there's going to be a failure, and there's going to be a liquidity crisis, we want the money. Why should we do repo transactions? And when you do a repo transaction, you give the borrower cash, and you take back government securities as collateral, and you take more in market value securities than you gave in cash. That's the haircut, so you have a little bit extra collateral. That's considered the safest kind of financing transaction you can have because it's fully collateralized, exempt from bankruptcy laws, liquid, et cetera, et cetera. If the banks won't do that, and they're not doing it, what does that tell you about global liquidity? I won't lend money against the safest collateral in the world, the safest, most liquid collateral in the world. I'm so fearful that I won't even do that transaction. I want the cash because I'm concerned that my counterpart may go bankrupt and that the treasury market itself could experience a liquidity crisis. That would account for why the banks won't lend money. And so the Fed, this image of stuffing a goose so you can get a nice pate, the Fed is stuffing the goose. The Fed is stuffing the banking system with cash. But at least so far, the transmission mechanism is broken and the banks have been unwilling to lend that cash. And this is distress is going to continue. To the point, Velina, we are in a nascent liquidity crisis right now, as evidenced by what's going on in the repo market. And the only issue is, can the Fed force the banks to spread that money around? And they may, or will the banks continue to hoard it, in which case this will get a lot worse. So we may actually be in a crisis today.
Okay, thank you, Jim. Are there questions in the audience? Feel free to ask anything. We have an American guest. You can ask from, questions starting with Trump's administration, federal
Could be a long answer.
Just be prepared for it. It's coming.
Okay, looking at the first chart, where we've seen the declining growth rates, the blue bars, the red bars with recession have not been increasing. Would you want to assume that the recession bars would increase at the same time when the growth rates are going down? So meaning that the next recession would be bigger than the last one. So what's your outlook for the next recession in this respect?
That's exactly right. The expansions are getting longer but weaker, but I didn't really talk about the recessions, and they show them being, the last one was quite steep, but fairly short compared to some earlier recessions. This is because the Federal Reserve has become more of an activist in attacking recessions. And for example, in 2008, what happened, we saw a sequential collapse. So March 2018, Bear Stearns collapsed. June 2018, Fannie Mae and Freddie Mac, our mortgage agencies, collapsed. September 15, 2018, Lehman Brothers filed for bankruptcy. Morgan Stanley was days away. If nothing else had happened, Morgan Stanley would have collapsed within days before the end of September. Then Goldman, then Citi, would have just been like dominoes falling. The Fed intervened. But what did they do? They, apart from cutting rates to zero and unlimited lending without really asking about the solvency of the borrower, they guaranteed every bank deposit in the United States. That's not the law. They were not required to do that. We had $250,000 of insurance. They guaranteed every bank deposit regardless of size. They guaranteed every money market fund in the United States. There was no law, there was no requirement to do that either. They just did it. They did $10 trillion of currency swaps with the European Central Bank because Deutsche Bank and the major European banks, they were in just as much distress as the US banks, but they had dollar liabilities, mostly in money market instruments to fund dollar assets. And when you're in distress, you turn to your central bank. And the problem is the European Central Bank doesn't print dollars, they print euros. Deutsche Bank needed, and I should pick on them as other banks, they needed dollars. So where were they going to get the dollars? Well, the Fed printed up $10 trillion. The European Central Bank printed up, however many 10 trillion euros, and they swapped them. And the Fed got the euros, and ECB got the dollars, and then they could pass them out to the European banks. That's how severe it was, and that's how extreme the remedy is. The problem is none of the problems were solved. We would have been much better off, in my view, going to something that looked more like a depressionary contraction and allowing a lot more banks to fail. Now, there are ways to do that. You could have nationalized the US banks, stripped out the bad assets, put them in trust for the American people, wiped out equity, calculate the hole in the balance sheet, give bondholders a 20 or 30% haircut, and then IPO the clean back. That would have been a way to get the economy moving again. Instead, they propped them up. Shareholders didn't lose any money. They did temporarily, but it came back. And this whole thing was sort of to preserve Jamie Dimon's bonus, which they did very successfully. But the point being, if you want an economic contraction is like a V. You go down really far, but you come back really strong. That is not what happened. We started down the V, but the Fed truncated it and turned it into an L. The problem with that is, yeah, it doesn't get worse, but it doesn't get much better either. You've given up your ability to have a strong recovery because you never hit bottom. That's debatable, but the point being, the reason the recessions haven't lasted longer is because Fed intervention has increased. But to do that, they had to print money and cut rates in such a way that they cannot get out of it, and that's why I call this no exit, and they're completely unprepared for the next recession.
Thank you, Jim. Obviously, the Eurozone economies are entering recession already, and you named also the problem with the US economy probably entering recession at some point, but the way how it develops is in a way, I mean, the European economies are much faster, right? Entering that phase. Now, we know also that there is going to be an institutional reshuffle within the European Commission, within the European Union institutions, and we are going to have a new president of the European Central Bank, which will be more political figure rather than an economist or central banker, right? So how do you see this, whatever it takes, 2.0 policies that obviously are going to be launched in order to face this recession, the way how you also addressed the problem with Federal Reserve and European Central Bank swiping, basically capitalizing on the euro-dollar system that's in place. I mean, how do you see this development and what's your take on it? It's going to be whatever it takes 2.0 and quantitative easing until eternity for the European economies, or where are we heading here in Europe?
Right.
In that matter?
A couple things. First of all, so Germany had a negative quarter. The best estimate for the current quarter, ending next week, looks negative. So Germany's going to be in recession. Italian growth is 0. UK had a negative quarter. They may be in recession. So I understand they're not in the Eurozone, but it looks like Europe is falling into recession. And then central bankers come along and say, well, we know what to do, cut interest rates to 0, well, you're negative, make them more negative. And we need fiscal stimulus, and everyone's looking to Germany for that because despite being in a recession, Germany's economy has more fiscal headroom, more ability to do this. But the problem is exactly what I was pointing out in the presentation. The reason I spent so much time in the United States is because I think all the points I made apply equally, maybe even more strongly to Europe. And you're right, Christine Lagarde will be the new head of the ECB. I think it's interesting that Christine Lagarde and Jay Powell are both lawyers. And we've given up on the PhD economist model and said, well, let the lawyers see if they can fix the problem. She's pragmatic, but she's highly political. And the best analysis I've read is that this was very much, in all the appointments you mentioned, Lena, very much engineered by President Macron of France. That he basically outfoxed the Germans. Partly a reflection of Angela Merkel's weakness, stepping down as party leader. She's at the end of her tenure. And it was a rare opportunity for the French to take the lead and really stack the deck. The problem is the central bankers and the fiscal authorities, in my view, are overestimating their capacity to stimulate the economy. And so the only thing that may work in the short run is a weaker euro. You may see the euro kind of drift down from the $1.11, $1.10. I don't think it'll go to par with the US dollar, but maybe $1.05 to the euro. So I think you'll see a slightly weaker euro. That may help a little bit. But bear in mind, the biggest slowdown in the world is China. Every reason to believe that the Chinese lie about their statistics. When they report 6.25%, 6.5% growth, 6.4. The first thing you have to do is realize that China, 45% of Chinese GDP is investment. That's extremely high. A developed economy, I know China's not a developed economy, but in developed economies, the investment component is closer to 25, 26%. Now, for a developing economy, normally that kind of investment is a very good thing. You're putting money into infrastructure projects and other projects that will more than pay for themselves, and that helps grow. The problem with the Chinese is they're not doing that. They're wasting at least half of it. I've got mud on my shoes walking around ghost cities, including ghost cities of the future, construction sites that are going to become ghost cities. And it's not one or two here and there. I think it matches something closer to 100 ghost cities all over China. I visited a site. They were building the south of Nanjing. They were building 7 ghost cities in a row. This is like out to the 20-mile horizon from a high point. But each city had a complex of 3 or 4 skyscrapers, a convention center, a resort hotel, a golf course, a metro stop, a highway stop, retail space, apartments, everything you would want in a modest-sized city, all empty, all of it. And then my Chinese, Swiss Communist Party officials, they go, oh, well, this laboratory is empty. I said, well, we're getting 5,000 scientists in here. We're actively reaching out abroad. We're getting all the Chinese to come back. I said, they're not going to come back. What self-respecting Chinese scientists working in Silicon Valley wants to come back to China? I mean, you'd much rather be in San Jose. And so these things are empty. They keep building them. Now, there's growth. I mean, it's real steel, glass, copper, cement, labor. That's all real. But what's your return on the investment? 0. So if you were applying anything even remotely resembling accounting principles, you would write that down. So right away, I take one half of the 45%, or almost a quarter of Chinese growth, and I erase it. So 6 is more like 4. Some analysts go a lot further, and I respect their work, and I have good reason to believe that real Chinese growth is maybe 2.5%, 3%, not the 6% plus you hear about. What is real is the debt. So they're in a worse situation than the United States, where the debt is expanding faster than the growth. The ratios are off the charts, completely non-sustainable, and to the extent that they have dollar-denominated debt, which they do, and they cannot print dollars, which they cannot, how are they going to pay off that dollar-denominated debt? Well, they got to dip into their reserve position. This creates potential currency crisis, and we've seen the fruit of that as China has devalued the yuan, now down to about, I think, 7.15 when I looked at it this morning. So this is just beginning, but the Chinese growth is a bit of a mirage. There's a lot of fraud statistics. It's slowing down faster than most outsiders realize. It's the U.S. and China together are almost 30% of the global economy, and this affects our friends in Australia, and it affects Europe.
Thank you, Jim. Questions from the audience? Yeah, please. That's all.
Jim, good to have you here. I gotta disappoint you because the Austrian School of Economics is not really well known in Austria. So if you say Hayek, for example, most people would think of Selma Hayek and not really of Hayek. So, but we're working on it. Jim, I wanted to ask you regarding the increasing pressure of President Trump on the Federal Reserve. I mean, that's something that we haven't seen in decades. It got worse and worse in the last couple of weeks. In a tweet he called the FOMC board and Jay Powell boneheads, which is not very diplomatic, of course. But on the other hand, he put the Federal Reserve in some sort of a catch-22 situation, I would say, because whatever they do, they will be kind of will be blamed. So, do you think that he is putting so much pressure on the Federal Reserve nowadays, mainly because he is concerned because of his re-election? He wants a lower dollar, of course, to import some inflation and to import some growth. Or is there some sort of a bigger story behind? I'm kind of referring to our mutual friend Trudy Shelton, who might become nominated, I think, and who is definitely an advocate of the gold standard.
Right. Well, thank you, Ronnie, for the seven-part question. But let me, no, that was great. Let me unpack that a little bit. And I said this a couple of years ago, but because we could see it, it wasn't difficult. Donald Trump owns the Federal Reserve. There are only 7 members of the Board of Governors. Now, people say, well, you have the regional Reserve Bank presidents, and there are 5 of them who get to vote at each meeting on a rotating basis, except New York, which has a permanent seat. So there are really 12 votes on what we call the Federal Open Market Committee that sets interest rates. But I can assure you that those regional Reserve Bank presidents might as well be spectators. The interest rate policy is run by the Board of Governors. The Reserve Bank presidents, they can dissent every now and then, they can make their voices heard. For that matter, all the non-voting members are in the room. There are 45 people in the boardroom at the Federal Reserve when they have these meetings, and they all get to say a little something. So this idea that it's this club of 12 is just not true. You have to focus on the 7 members of the Board of Governors, and in particular, the chairman and the vice chairman, and perhaps one other. Lena Brainerd has an important voice because she's the only one with really good grasp of international economics. That's what she brings to the table. So, what has Trump done? Well, there were 2 vacancies when Trump was elected. Why on earth did President Obama not fill those 2 vacancies before the election? Well, he thought Hillary was going to win. In fact, everybody thought Hillary was going to win. So as far as Obama was concerned, he was handing up 2 vacancies to Hillary Clinton to let her set the board the way she wanted during her 8-year administration, which never happened. So this ended up as a gift to Trump. So he had 2 vacancies from the beginning. Then you had several resignations. Stan Fisher was one, and I'm forgetting the other, but there were 2 important resignations. So all of a sudden, Trump had 4 vacancies on a 7-person board. Plus, Jay Powell was already on the board, but he got promoted to chair. So one by one, Trump has filled these vacancies. These are all his appointees. And no president since Woodrow Wilson has had as many. That's when the Federal Reserve Act was passed. Wilson started with a blank court. But no one since Wilson has had that many appointments. So this is Trump's Board of Governors. And Noel Brainerd must go in there and feel like a hostage at this point. She's the only kind of Democratic holdover at this point. And there are 2 remaining vacancies, because even though he filled the ones he had, there were more resignations, and Trudy Shelton should almost certainly be confirmed by late October if they're not too tied up with impeachment hearings by then. So there's a lot of signaling going on. Now here's what Trump is doing. Calling the bonehead stuff like this is for popular consumption. This is for voters in northern Michigan, not for Washington insiders. Typically what the president does, says nothing about Federal Reserve policy, has a quiet lunch with the chairman of the Fed once a month, maybe 4 times a year, and that's it. Trump's the opposite. He's on Twitter, he's out publicly, etc. But he's actually brilliant, and I'm not being sarcastic when I say that. What he is doing, he's not badgering the Fed, because the Fed has some independence, I'll grant him that. He is leading the Fed. You know, when you go hunting or you're shooting clays, You never aim at the target, you aim ahead of the target, and you lead the target, lead the prey. And that's what Trump's doing with the Fed. Trump knows they have to cut interest rates. So as long as you know they have to cut interest rates, which they do, even if Trump didn't say a word about the Fed, they have to cut interest rates. So why not get credit for that? So all he's doing, you guys, you didn't cut them enough, 25, should have been 50. What are we waiting for? He said something not too long ago, a week ago, about negative interest rates, which is radioactive inside the Fed. I mean, they talk about it, but they don't want to go there. But say, why is the president talking about negative interest rates when the target is still 1.75%? Seems like we got 7 rate cuts to go, which they do. But Trump, I think, is playing this brilliantly. He's leading the Fed where the Fed has to go anyway, and will get all the credit as and when they go there. And if for any reason they don't, and the economy goes into recession, they'll get all the blame. So I would understand this. I don't give Trump any credit for deep understanding of monetary policy, but I think he's a brilliant political tactician, and he understands the importance of the Fed. Look, the way Trump thinks about it, everyone gets spun up about consumer expectations and consumer satisfaction is a higher level, et cetera. And economists try to make forecasts based on it. It has no predictive power at all. Consumer expectations correlate to one thing, which is the stock market. Stock market's up, consumers are bullish. Stock market's down, consumers are bearish. Simple as that. But that translates into votes. So Trump has boiled us down to a simple equation that you just have to keep the stock market up. Well, what do we know about the stock market? They love interest rate cuts. So as long as you keep cutting rates, which you probably have to do anyway for the reasons we discussed here, the stock market will remain buoyant and consumers will be happy and they'll vote for Trump. So this is actually a pretty deep political calculation without giving too much credit for understanding monetary theory. As far as Judy Shelton is concerned, I have enormous respect for her. I think she'll be a breath of fresh air. The idea that she's going to walk into the Board of Governors and convert the U.S. to the gold standard is nonsense. That's not going to happen. But just introducing gold into the conversation, or going back to my last slide with Roosevelt and Nixon, like the problem we're facing, the insoluble problem, does have a solution, and it involves a much higher price for gold, and we have 2 presidents to prove it. She has that kind of historical perspective that I think getting that into the conversation will be very helpful.
Okay, thank you, Jim. There are more questions on the side of the audience, because we are slowly but surely approaching the end of this Q&A session. If there aren't any, I have 2 more questions. Before we go for the most exciting part of this session, let's be honest about it, there's going to be a small cocktail reception afterwards, where we all can engage in some conversations, and you can also use the opportunity to get a book signed by Jim personally, or if you are interested to buy his new book in the German translation. Well, I have 2 direct questions for you. The one is, when is the next financial crisis coming?
Right. The first, that's one of the questions I'm asked most frequently. And the first point I make is that you have to bear in mind the difference between a business cycle recession and a financial crisis. 1987, 1998, 2000, and there are other examples, were all financial crises that did not result in a recession. In 1998, we were hours away from shutting every market in the world. That was the long-term capital management, Russia default, bailout. I should raise my hand. I was the lawyer for long-term capital. I represented them in that negotiation. But we got it done, brought in for soft landing, but we were hours away from a sequential shutdown of every market in the world, beginning in Japan and going around the globe. But there was no recession. There was no recession in 1998, at least in the U.S. Our economy grew very strongly, and then the dot-com bubble hit all-time highs. 1987, the Dow Jones stock index fell 22% in one day. Not a week, a month, a year, one day. That would be the equivalent from today's level. That would be the equivalent of 5,000 Dow points, slightly more actually. If it goes down 500 points, that's front page news, headlines all over the world. Imagine 5,000 points. That happened in 1987, no recession. You know, so forth. I can give many examples. We also had recessions with no panic. 1990, we had a recession. There was no financial panic. 2000, we had a mild recession. There was no financial panic. It was a dot-com crash, but that wasn't leveraged and didn't spread beyond specific cycles. But sometimes they do go together. 1929 and 2008 were examples of where a financial panic and an economic cyclical recession happened at the same time. So sometimes they go together, often they don't. You have to separate them. So we could, in the United States, Europe is ahead of us, but the US could have a recession in late 2020, early 21. That doesn't mean a financial panic. But we could have a financial panic that is just on its own. We might be in one right now, as I mentioned. This is pretty serious with what's going on. That's not printing $1 trillion for the fun of it. So we can say with a high degree of certainty it will come and it will be worse than 2008. I feel completely confident in making those two statements for a lot of reasons that are actually in my books, having to deal with complexity theory, scaling metrics, the worst case being an exponential function of scale, not a linear function. So there's a lot of science behind that. As far as when, that's the most difficult. People say, well, what good is that forecast? Well, it's the same with earthquakes. You can say with certainty that earthquakes will occur in certain places, and you can estimate the magnitude. But earthquake scientists had no success at predicting the timing of earthquakes. But what I say to investors and savers is, what are you waiting for? If it's coming, and you know it's going to be worse, and people say to me, in fact, you know, some people say to me literally, Jim, would you call me at 3 o'clock the day before, and I'll sell my stocks and buy gold, and I'll be all good. And I say two things. Number one, I'm not going to know the day before. I can see it coming, but I won't know with that precision. And if I did, I'd probably be a little busy myself. But the real point is, when the crisis hits, you're not going to be able to get gold. The dealers will be back ordered, the mints will be back ordered, the big funds, some of the banks will be able to get some. There's not nearly enough physical gold. There's probably, if you look at all the gold contracts, futures, options, ETFs, London Bullion Market Association, unallocated forward contracts, if you add up the nominal value of all the paper gold, the amount of physical gold behind that might be 1%. Might be 1%. And what's going to happen to all those contracts? They're already terminated. I'm enough of a geek. I've read all the major exchange rule books. And one thing that always jumps off the page to me is every exchange rule book has a rule that says they can change the rules. You know, the Hunt brothers in 1980, 81 whined about the fact that they cornered the silver market and the government changed the rules. So it's like, well, they always do that. You should expect that. And what the COMEX will do, for example, will terminate all the gold futures contracts. They'll say correctly, because this is also a rule book, we are not a source of supply. We're a hedging vehicle. You can speculate if you want, manage your position. We are not a source of supply. So if all the long futures holders send in notice of delivery, which is rare, but if they did to get the gold, the COMEX will simply shut down trading, terminate the contracts. They won't steal your money. They'll send you a check for your mark-to-market profits as of the close of business yesterday. And you'll say, wait a second, I don't want yesterday, I want today, I want tomorrow, that's why I bought this contract. They'll say, too bad, you terminate it, you know, whether it's force majeure or other provisions, here's your money, but you will not have the long gold exposure that you thought you had on a going forward basis. The same will be true of ETFs and these other contracts. So the only way to be comfortable, if you want a slice of gold, I recommend 10%, but you know, seasoned to taste, get physical bullion, put it in a safe place, and do it now. Because when the crisis hits, you will not be able to get it. And your paper gold will not save you because that will be terminated. The short answer, Velina, is you can see the crisis coming, you can estimate the magnitude, timing is always uncertain. And that's not a case of just throwing up our hand and saying, oh, I don't know. This actually is science. Based on complexity theory, which no one on Wall Street uses, but it's actually has the best predictive power because capital markets are complex systems. The science will tell you that emerging properties always come by surprise. That's just how it works. And so, but having said that, 10 years, 11 years since the last one, these things, you know, if you say the tempo was 1987, 1994, the Mexican tequila crisis, 1997, 98, Asia-Russia long-term capital, 2000, dot-com collapse, 2007, mortgage collapse, 2008, global financial panic. If you look at that tempo, you would say, these things happen every 6, 7, 8 years. Well, it's been going on 11 years since the last one. Again, what are you waiting for?
Thank you, Jim. Well, maybe there is one major difference between the last great financial crisis in 2007, 2008, and the previous ones, which is contagion. They make obvious the case that now we are living in a system that is quite interconnected. All socioeconomic systems are interconnected. Contagion is spreading quite fast. So my question is, having in mind that the last time the too big to fail banks were saved, or let's say bailed out by the governments, which means by us, the people, who is going to bail out the central banks now in case of a great financial crisis 2.0?
That's a great question, and the two parts of it, contagion and who bails out the central banks, are intimately connected, and here's what I mean. So contagion is very, very cool. We all know what it is. It's, by the way, the mathematics of pandemics are exactly the same as the mathematics of financial panics. If you look at how they spread exponentially, and pandemics tail off because everyone's dead. If everyone's going to get the disease is dead, and so it goes away. That could happen in a financial panic if you let institutions fail, as we saw with Lehman Brothers. The problem is the Fed intervenes and truncates the contagion, but let me come back to that when we talk about central banks. So that's critical because in 2000, I mentioned the dot-com, I'll call it the dot-com collapse, not the dot-com crisis, but the dot-com collapse. I mentioned that a couple of times. The NASDAQ dropped 80%. It's one of our stock market indices between January 1st, 2000 and the end of 2001. That dropped 80%. But there was no panic. There was no contagion. If you happen to own pets.com, you lost all your money, but it didn't spread. It didn't go international. It didn't take down the banks. It didn't have all the effects that we did see in 2008. Why was that? And this is something that Janet Yellen never grasped, and I don't really think Bernanke grasped, which is that there was no leverage. In other words, if an asset drops, but it's not leveraged, you lose. The asset holder loses, but nobody else loses. But if it is leveraged and the value goes down, you walk away and stick it to the banks, and now the bank's in distress. And then that bank is borrowed from other banks, and then one bank fails, and then that spreads to the other banks. The minute Lehman Brothers failed, everyone said, well, who do they owe money to? Lehman's out, who do they owe money to? And then that's where the contagion comes in. That's where you get to Morgan Stanley, that's where you get to AIG, etc. And so the point being, if you're trying to look at a financial collapse and estimate whether or not there will be contagion and a much broader financial crisis and perhaps a global liquidity crisis, you have to ask yourself, how much leverage is behind these asset matters? Because if there's not a lot, you might get a contained collapse. But if there is a lot, you're going to have contagion and it will spread. And then at that point, the psychology takes over. And it doesn't even matter if somebody's in distress. I'll assume they're in distress because I don't know any better and I just want to get out of the way. So now, coming back to the crisis I mentioned, what happened in 1998? The 14 largest banks on Wall Street, I call them 14 families, got together and rescued a hedge fund. And nobody wanted to do that. I was at the hedge fund. We didn't think we were going to get rescued. Who cares about us? They were losing money. But the idea that Wall Street would bail us out never occurred to us. We told the Fed what was going on just to be good corporate citizens, but we didn't expect a rescue. But the problem is we had $1.3 trillion of notional value of derivatives. Well, who was on the other side of the derivatives? Wall Street. So I used to say, if we had filed for bankruptcy, I could have just slept in the next day. It wouldn't have affected me very much. But Wall Street would have received $1.3 trillion of exposure because they're middlemen. If they wrote a equity total return swap to us, they bought it from somebody else. And they were taking a spread. But the minute you take out half the trade, the other trade then becomes a net long or short position. You have to go out and cover it. And imagine trying to sell $15 billion worth of stock in one morning. That's Peter Fisher, who was the head of the open market operations at the Federal Reserve, spent a whole day with him on a Sunday going through the positions. And when we were done, it took hours, and when we were done, he looked at me, and his face was white, and he said, we knew you guys were going to take down the bond market. We didn't know you were going to take down the stock market too, because we were the largest risk arbitrage firm. No one knew that, but we had $15 billion worth of stock position. So my point being, that Wall Street bailed out a hedge fund. Flash forward 10 years later, 2008, what happened? The central banks bailed out Wall Street. Now it wasn't a hedge fund that was in distress. It was Lehman, Morgan Stanley, Citibank, Goldman, and the rest. And the central banks bailed out Wall Street, and we talked about those numbers earlier. So come forward, 2020, 2021, pick a date. Who's going to bail out the central banks? Because if the Federal Reserve had been able to get its balance sheet from, say, $4.5 trillion down to even $2 trillion, and they had been able to get interest rates from 0 to 4, I would be the first one to compliment them. I say, hey, nice job. You saved the world, and you normalized, and you're ready for the next one. But they failed. They haven't normalized. They did not get the balance sheet down. They're expanding at $1 trillion. They did not get interest rates up. They're cutting them again. They're not ready for the next crisis. So what are they going to do? There's only one clean balance sheet left in the world. That's the IMF. So, and they can print world money, this special drawing right, the SDR, which is, I call it world money. That they always give these things funny names because they don't want people to understand what they really are. Like, why is our central bank called the Federal Reserve? It's because Americans hate central banks. We had two and we got rid of them. One in 1816 and one in 1836. So when Morgan and other interests, Warburg and other interests cooked up a new central bank, they said, don't call it a central bank, because Americans say they call it the Federal Reserve, they won't know what you're doing. The same thing with the special drawing right? What the heck is that? Well, it's world money. The IMF could come together and re-liquefy the world by issuing $1 trillion equivalent or $1 trillion SDRs, which would be worth about $1.3 trillion. Now, I had this conversation with Tim Geithner because I've always hypothesized that that's what they would do. They're the only liquidity provider left if the central banks can't do it themselves. And he strongly disagreed with that. I said, well, Mr. Secretary, what are you going to do? And he said, and he took a breath and looked at me and said, guarantees. In other words, he was accepting my point that the Fed could not print trillions more, that there was a limit on that. But what they could do is just guarantee everybody, which they did do the last time. As I mentioned, they guaranteed the money market funds, they guaranteed the bank deposits, they effectively guaranteed the ECB with the currency swap, they just spread the guarantees around. So that was his answer, and that's important because he's not just anybody, he's in this super elite milieu, and that tells you what they're thinking. But my rebuttal to that is, what happens if people don't trust the guarantor? How good is the guarantee? If people have lost confidence in the guarantor, how good is the guarantee? It's like buying insurance from an insurance company that's going broke. Well, your insurance is no good. And I had a separate conversation with John Lipsky, who until a couple of weeks ago was the only American ever to have the IMF. He wasn't supposed to, but they arrested Dominique Strauss-Kahn, and John had to step in as acting managing director. And we had the same conversation, I had with Geithner, and what Lipsky said is, Jim, don't underestimate the degree of difficulty of getting anything done inside the IMF. He said, they're really slow. And he said, you think that SDRs are a solution? He said, theoretically they are. But if you want to see somebody break out in highs, mention SDRs to the Germans. He said, the Germans don't want to hear about it. because it's just, they know it's just another form of money printing. So he said, it could happen, but it might take 6 months or a year, perhaps longer, before the IMF could reach consensus. And meanwhile, you got China throwing spitballs because they want this to mean the end of the dollar, which is probably on that path. So in my own analysis, I'm like, all right, Geithner and his cronies are relying on guarantees, but we might not have faith in the guarantor. I see a theoretical case for an IMF rescue. The head of the IMF is telling me privately that they're not that nimble. So the only way out is to shut the institutions, close the New York Stock Exchange, close the banks, turn off the ATMs. They'll give you $300 a day or 300 euros a day for gas and groceries, but that's all. And basically shut down all the markets and say, we'll get back to you once we fix this. And now I say things like that, people just roll their eyes and go, oh, that's crazy, that would never happen. I say, no. The New York Stock Exchange was closed for 5 months, from August to December 1914, after the outbreak of World War. It was closed for 5 months. FDR, President Roosevelt, by executive order, closed every bank in the United States. He gave speeches that every bank is closed. And they were closed. And he didn't give the American people a date when they would reopen. It happened to be 8 days later, but nobody knew that at the time. If you think that they won't turn off the banks and the ATMs, just talk to people in Greece and Cyprus. I mean, people in Greece were flying to Frankfurt with empty suitcases, filling them up with 100-euro notes, and flying back to Athens. The banks were closed, the credit cards didn't work, debit cards didn't work, ATMs were closed, nothing worked, and they were flying in cash so they could avoid barter. So these things have happened.
Thank you, Jim. Maybe there are, now I see more questions. If the audience is patient enough to have one last round of questions. Yeah, please.
I mean, the label to the final thing would be currency reform.
I agree with that completely. And
Sorry, did you say you agree or disagree?
I agree with that completely. And I've had this conversation with a lot of
new currency for.
yeah, basically, you call it a reboot or reformation, reform of the international monetary system. And in my conversation with Bernanke and Lipsky, 6 months and 9,000 miles apart, two separate conversations, they both use the word incoherent to refer to the existing monetary system, which I agree with. And I knew they didn't rehearse that for my benefit. This is just in the air. The system is incoherent, which just means there's no standard. You know, currencies are just measured against each other, but there's no single objective non-fiat currency standard for measuring any currency, except gold, which is not really part of the conversation. So there are two ways that can happen. One is a convening power, and certainly the United States could play a role, but no reason Europe and China shouldn't be right in the mix. One or more convening powers would organize a new international monetary conference. I mentioned it was just at Bretton Woods. I have a chapter in my book, Aftermath. I call it the Mar-a-Lago Accord. But you know, if Trump were doing this, sure you'd want to have it at Mar-a-Lago. It kind of resembles the Genoa Palace where they met in 1922. And sit down and hash it out. My point there, your seat at the table, if you were Germany or France or China or the US or Canada or anybody else, is going to be determined by the amount of gold you have. It doesn't mean we automatically go to the gold standard, but it's like a poker game. You want a big pile of chips. Those with the significant amounts of gold, including Russia, are going to have a good seat at the table. The people with the chairs against the wall are going to be places like Canada. I personally have more gold than Canada. I'm not saying I have a lot of gold, but Canada is 0. So if you have 1 gold coin, you have more than Canada. Australia, same thing. And so they're not going to be big voices. Europe will be. If you combine all the members of the Eurozone, they have more gold than the United States. Now, it's not all owned by the ECB, of course, but collectively they have 10,000 tons. Germany is 3,000, France over 2,000, Italy over 2,000. My favorite quote from Mario Draghi, he was giving a speech at Harvard not long ago, and so they take questions from the students, but one guy, a friend of mine, is more of a reporter, he kind of snuck in the back, and I guess Draghi thought he was a Harvard student, but my friend said, Mr. Draghi, what are your thoughts on gold? And Draghi, I was floored, and I had this on tape, you can find it. He said, well, remember, before I was head of the ECB, I was the governor of the Bank of Italy, Banco d'Italia. And he said, I never sold an ounce of gold, not one. I always considered it a prudent hedge against the collapse of the dollar. So it was a candid moment, but I think it shows you that gold still plays a role. And so that's one way to do it, proactively. The other way to do it is not do it, have a crisis, and have to do it on a very improvised ad hoc basis, which almost always produces the worst decision-making and the worst outcome. But either way, you're going to have to face up to it. But I think I would do it proactively.
Okay, and one final question from the audience.
Thank you for the talk. Just a quick question. How are we going to have inflation expectations when the methodology is changing? So if you take the US labor statistic and how inflation has been calculated, the one number we see always taken down. So we are using right now the economies method or the Ching method, which in one case, if you have two items, one increases the prices a lot, but other one not. So there is no inflation because people choose the other one, and that's how it's even explained there. So that is obviously as a result of politicians that they want to keep inflation low, which is not the same as central banks. But if there is eventually a need for inflation expectations to increase, and these methodologies keep changing always, lowering down the number, how do we occur that?
Right, a very, very good question. And the first point is there are 20 or more definitions of inflation. Whenever you get into an inflation discussion, you have to say, well, do you mean CPI, PPI, PCE, core, non-core, year-over-year, month-over? So many different ways to calculate it. If you get into hedonic adjustments, it's even more complicated. So you're exactly right about that, except they're all pointing lower. I mean, even within all these variations, they're pointing lower. As a forecaster, policy forecaster, it never does any good to think about what I want to happen, because my opinion is irrelevant. You have to put yourself in the minds of the policymakers and say, well, what are they thinking? And the Fed tells us what inflation measure they're using. It's PCE, core, year-over-year. It's technical, but that's dropping. So they see this and they're willing to expand the money supply, as I mentioned several times. They're printing $1 trillion in the next couple of weeks. But the problem is the one I mentioned, which is velocity, and that is psychological. And you are not going to get inflation unless you can change inflationary expectations, unless you can change behavior. And the problem with what happened in 2008, on top of what happened in 2000 with the dot-com, you know, I grew up in the 1950s and 1960s. Well, my parents lived through the Great Depression as children, and my grandparents, whom I knew, lived through the Great Depression as adults. The impact of that, the trauma of that, was intergenerational. Even in the 1950s and 1960s, my mother was still saving newspapers and tin cans and stuff because that's what you did during wartime and depression. It really took the baby boom generation to leave that in the past and become, you know, profligate spenders. So what happened in 2008 may be intergenerational. I have, you know, part of my audience are people 60, 70 with, you know, significant savings and they want to know what to do, but I have a lot of millennial followers, readers, etc., and some of them have money, but it's not so much that they have so much money, but they saw what happened to their parents in 2008. They don't want to repeat that mistake. They don't want to be disadvantaged in the same way. They're actually kind of conservative when it comes to money. So the whole playing field is tilted in favor of more savings, less spending, and more deflation. So how do you change that? You have to basically steal from everybody, which is what inflation is, in such a way that it makes people want to dump the money. It's really unfair. When I forecast things, it doesn't mean I think they're good things. But it means it's what's coming. And so inflation is just a form of theft, it's a form of confiscation, it's a form of taxation, which is what Keynes called it. But it can have the knock-on effect of inflating everything else. The reason to raise the price of gold, or to value the dollar against gold, is not to reward people who hold gold. That could be a consequence, but that's not the reason. The reason is to cause people to lose confidence in the money in such a way that everything else inflates. So the world of, I'll just say $5,000 gold, $5,000 an ounce, nothing happens in isolation. $5,000 gold means $200, $300 oil, $10 copper, wheat, corn, everything goes up because nothing stands alone. So that, and gold is the easiest, fastest way to do that.
Okay, and I saw a lady who also wants to ask a question.
Thank you so much. My question is, how would you consider the role of Brexit for the future global financial situation? And as a very small example, the people who are blocked with the Trump agency, with Cook, like an international issue. Thank you so much.
Thank you. Brexit, I think, in two dimensions. One is a purely economic one. Well, what does it mean with trade between the UK and the European Union? What are the prospects for a bilateral trade deal with the United States? The UK obviously has a lot to offer, but are they shooting themselves in the foot? These are all the economic questions surrounding Brexit. And my own view is that they'll do just fine. I always said that the UK, this goes back to the 1970s and the 1990s, there were two things that I thought would be really intelligent. One would be to keep out of the European Union. That was okay. The other one was join the European Union and adopt the euro. I thought that would be okay. What they did was the worst of both possible worlds. You got all the regulation, all the bureaucracy of Brussels, but without the benefit of a pretty large currency that's a larger market than the United States. And so they chose the worst possible path. It was always going to be non-sustainable, and they've chosen to leave. But there's another level of this that you have to consider, which is that they did have a referendum. If you want to fault somebody, blame David Cameron. They didn't have to have the referendum. That was just a bonehead. Speaking of boneheads, as Ronnie said, that was just a bad move and an unnecessary move. But they did it, and they voted to leave the EU, and there was a clear outcome. It wasn't all that close. Well, here we are 3.5 years later, and nothing's happened. What does that do for confidence in the parliamentary system, confidence in democracy, for that matter? How do everyday subjects in the UK view the elites? We start to conclude, well, the elites are dishonest, they're globalists, they don't care what we think, it was all a sham. And so Boris Johnson, to his credit, I know he's ruffling a lot of feathers, but he at least is standing up for the everyday British subjects who voted to leave. And he said, all right, we're going to leave. So it will, in my view, it will happen. I think he's dead serious when he talks about October 31st. The EU, they don't want to, but they may make some small concessions just to get this thing behind them. But the point is, if you extend this another 3 months or 6 months, you'll get to the point of social unrest in the UK. So it has a big economic dimension, but I think it has a big dimension in terms of faith in government, and I think Johnson, to his credit, is very aware of that.
By the way, Jim predicted the outcome of the Brexit referendum correctly, and he also predicted the election of Trump. And speaking of Trump, what do you think? Is he going to run again for a second mandate? And if, what's your take? Is he going to be re-elected for a second term?
He is going.
Very short answer,
Sure.
because we are really stressing the patience of our audience, and we are all thirsty. So very short.
Right. Well, the shortest possible version is yes and yes. Yes, he is running. Yes, he will win. And when I predicted Trump the last time, to the shock of other people and also Brexit, I want to make clear that I don't guess. I have models. I'm not saying the model is perfect or infallible, but it's better than any other model I've seen. It involves hard science, Bayesian statistics, complexity theory, behavioral psychology, a lot of inputs that are not widely used. And I'm using the same model now. When I give Trump's re-election a 65, maybe slightly higher, 67% probability as of now. But there's a theta element, so I expect that to get stronger. So by election day, November 2020, it might be more of a 90% probability of re-election. Right now it's 67%. I'll just give one factor. It's a multi-factor model, but the single most important factor, Trump's likelihood of winning, is the inverse probability of the likelihood of a recession before the summer 2020. So recession odds, I put at about 35%. Others are in the same camp. It might be a little higher, because if you say the odds of a recession before the summer 2020 are 35%, then Trump's probability of winning is the inverse of that, which is 65%. But every month that goes by, the odds of a recession go down because there's less time to have a recession, and so the odds of Trump winning go up. And just for historical perspective, every president in the 20th century who sought re-election, went for a second term, won, unless there was a recession. People immediately say, wait, Jimmy Carter lost and George H.W. Bush lost, and that's true. They both had recessions in their last year in office. If an incumbent president runs for re-election and doesn't have a recession, he wins. Maybe in the future she'll win. But that's the history of it.
Thank you very much. Thank you, Jim, for being with us, for answering all the questions that we had, and you will be always a dear guest to us here in Vienna, to our institute, and to me personally, it was a very big honor to have you here, finally, here in Vienna. And as I said, now we have the most exciting part of this afternoon's presentation, which is the cocktail reception on your left. And then we have also book sales and book signing for those of you who would like to buy the book. It's the German translation of the last book. And also if you have some personal questions, Jim is staying with us for maybe another hour. Let's see how this evening develops. And I want to extend also my gratitude to all of you for staying with us until the very last moment, which is almost 2 hours. And I really appreciate it. Thank you very much and have a great evening. So